smaller position than normal going into this particular earnings report for this second play, all right? And that stock is home builder Toll Brothers. Toll Brothers is the play. TOL is the symbol. TOL is the symbol, and earnings are going to be coming out tomorrow before market opens. It's February 22nd. Okay, tomorrow before market opens. That's when the earnings are coming out, and I think that Toll Brothers is going to put up very good numbers, and I think the stock may break out through $32 per share and make a run towards. I hate when that happens. But I think the stock may break out through this $32, just basically break out through this base, and then make a run towards 33 and start to challenge these previous 52-week highs. This $33 level from here, and then from here, and then maybe actually rip higher since then. The stock is, technically speaking, once again, let's evaluate this based on three things, right? Fundamentals, technicals, and unusual option activity. So let's look at it from the technical standpoint. The stock is forming technically a base here. It's pretty neutral at best. There's no momentum behind this. It's not running. It's not making higher highs and higher lows. It's not going down. It's just a flatlining process, right? It's not done much for 3 months straight. It's basically confined to this $31 to $32 tight range. Hasn't really done much, okay? But let's take a look at what has happened in the last couple months that will probably start to give us a little bit of a picture on the technical side that's better to understand than just looking at a plain technical view here that doesn't really give us much color. So, but big picture is this, on the technical side. For now, the stock looks essentially neutral, right? There's not much going on over here. On the option side, I want to mention that if you go to TOL, you'll see that there's volume building right here. This March 31 strike puts, okay? 1,100 contracts trading over here. March 31 strike puts. These were sold to open, okay? These are put sellers. These are put sellers. These puts were sold to open from 55 cents to 65 cents credit. They were sold all on the bid. So it's not a lot of cushion with the stock trading at 31.60. These are small bulls that are looking to get long if the stock does sell off post earnings and they get a chance to basically buy common at $31 per share. So these are put sellers. It's not a lot, about $70 to $75,000 worth of put premiums have been sold at March 31 strike. All right, but nonetheless, it's a slightly bullish view because these are put sellers under the stock going into earnings tomorrow morning. All right, and now on the fundamental side of things. Now, I'm going to try to put a picture here that try to follow a story here. I'm going to try to tell you a story because that's how I see stocks. And then I try to find how this story may end. It's like reading a beautiful novel or something, and then you're trying to jump ahead of the pages to trying to find out what the end conclusion would be. So that's what I try to do. Try to read a story over here, see if I can layer that over the chart and try to explain a little bit. Okay, so the first thing is that here is the view. Here is the view that from the activity tracker. Hold on a second. Here's my tracker notes. I want to show you something that what we have seen in the past on Toll Brothers. And here is here's the Toll Brothers view. Okay. Now watch this. Back on August 23rd, when the company reported earnings, this is what we saw. EPS was in line. Revenue, very nice beat. Number of contracts signed up 18% year over year. That's very good. Average selling price of homes jumped again from 829 to 831,000. Average selling price was up 14%. Total backlog reached a new record high of up 19%. And average price of homes in the revenue backlog also increased 844,000. I mean, everything looking great. This was on August 23rd, right? And then on December 6th, this is the last quarter the company reported in early December. Huge beat. I mean, this revenue backlog that they reported back in August 23rd was implying strength. Okay, so what did we see on December 6th? We saw huge EPS beat. We saw very good revenue beat. $1.86 were to $1.73. Sorry, 1.86 billion versus $1.73 billion. Revenue growth expanded even further, up 29% year over year, which was an acceleration from the last quarter. All right. The total number of new orders accelerated. The total number of deliveries basically rose again, and the total order growth was 20% year over year, way above the consensus view of 12.9%. So a very good quarter back in August, and even better quarter on December 6th, right? So this is pretty good, right? And so here is the stock. Here is the stock you see on December 6th. That's what happened when the company posted earnings. That massive quarter that I just showed you from here, the stock ripped higher big time, right from here. Okay. Now there are two important things whenever you're evaluating a home builder. The first one is the actual average selling price of homes, which in case of Toll Brothers has gone from $823,000 to as high as $844,000 per home. Right? That's a big variable in trying to determine the revenue. And the second, the home deliveries, the number of contracts being signed, the actual percentage increase in home deliveries. Both of those are very, very strong in the December quarter. But then this happened. Okay. Now let me show you a couple pictures that is going to actually show you the story. You look at this. This is the first snapshot. This comes from Bank of America. On December 6th, when the company reported earnings, they said, this is about fiscal year 2017 guidance. They said, average selling price expected in the range of $775,000 to $825,000 range versus Bank of America estimate of $844,000. That's a big negative. That means that the mid price of the company guided for fiscal year 2017 is $800,000 versus $844,000 that they reported the last quarter. That would equate to almost 5% declining average selling price in fiscal year 2017. That something does not make sense. Why would the company guide so low in fiscal year 2017 when average selling price declining after showing 2 straight quarters of growth and reaching 844? Here's another view that came. Now this one comes from RBC Capital in their earnings preview. And in this case, this is the earnings preview for tomorrow. See how negative the street is, which is what I'm trying to tell you a story over here. Tomorrow, going into earnings based on the guidance that the company provided back in December, RBC Capital has a scathing preview going into earnings tomorrow. They're so bearish. They see average selling price of only $768,000, which is gonna be 12% decline year over year. And they do believe that the deliveries will be relatively strong, but even with the deliveries, they're expecting only 6% increase in deliveries. This is in the quarter that will be reported tomorrow. But they believe that the average prices will collapse so fast to 12% that the net, they're expecting revenues to come down. They were expecting revenues to come down by 6.7% year over year tomorrow when the company reports earnings. So this analyst is very bearish. Bank of America is very, very bearish. I just showed you 2 articles, one from Bank of America, and this is today. This came out today from RBC Capital. All right. Now, so why are these guys so negative after 2 straight quarters of monster beat here and monster beat here? The question I'm trying to ask is, did the management set itself a bar that is extremely low so they can beat that easily? That's the main question over here. They beat here big time, but they provided a very muted view on the 2017 guidance, which has led both Bank of America and RBC Capital to really lower expectations going into the quarter. Has the management set itself a very low bar of expectations going into earnings tomorrow, which means they could easily surprise and blow these estimates out of water? Can they? That becomes a big question. Well, let's see. Here are the housing starts. This is housing starts. See these permits right here? This is the orange line. This thing broke out sharply. And these are the housing starts. If you drill further into this particular data point, this, by the way, came out last week on Thursday. okay, last week on Thursday. So this is January housing starts, and it basically showed that there was a massive uptick in the new housing starts in the month of January, which basically is now reaching the highest level that we saw since November of 2015. That's a 2-year high, this orange line. This is a forward-looking indicator, and if you drill further down into this, you're going to find out that Northeast region was the strongest, precisely the region where Toll Brothers has the biggest presence, all right? This is not telling me anything negative over here. I don't know why these analysts are so bearish to, both Bank of America and the and RBC Capital going into earnings. Maybe management set itself a very low bar of expectations going into earnings because these housing starts are very strong. Let me show you another view. This one also comes from Bank of America. Right in their own report, they said something that caught my attention and yet nobody is paying attention to. Bank of America, back on December 6th, said this, and this is a line. Through the first weeks of first quarter 2017, TOL's non-binding deposits, which have historically converted to orders at a 65% rate, increased 10% year over year, 14% if you exclude the Coleman acquisition. Why is this important? When the last time company reported earnings on December 6th, the company was already 5 weeks into the quarter. So they had a little bit of the visibility as to how the quarter was shaping up. And in that quarter, in that particular thought, about the current quarter, they said that, look, our total deposit base from consumers for new orders, for new homes is up 10% year over year, or if we exclude Coleman acquisition, it's up 14% year over year. So they had visibility already 5 weeks into the quarter. Guess what? 14% year over year. Guess where the consensus is going into the earnings tomorrow? And that goes back to the RBC Capital view. And it's right here. RBC Capital, which is talking about the same thing, new order performance as it relates to the high deposit levels reported in the first 5 weeks. The quarter was up 10% excluding Coleman. RBC Capital says that they believe that the order growth was no more than 6% year over year. And that's despite the fact the company told us on December 6th that it was up 14% year over year, or if you exclude Coleman, then it was up 10% year over year. So again, I'm finding a big disconnect over here, which is simply based on the basis that management may have set itself a very low bar of expectations by really killing the guidance altogether for fiscal year 2017. Maybe they were a little bit worried about elections. Maybe they did not know what was going to happen with the interest rate. Remember that they reported earnings on December 6th, and the FOMC decision with the interest rate hike, first time in a whole year, came on December 15th to 16th. So maybe the management was a little bit cautious into going all those events. I don't know. But they really lowered the guidance, and the investing community and the analyst community has bought into that. They have lowered the expectations as well, which tells me that the bar is low, and I think they could surprise to the upside. Now, given all of this discussion, there is still a chance that I might be wrong about this. Maybe analysts are right. Maybe management did guide down for the right reasons. I don't know. And that's precisely why I want to emphasize that if you're going to go into this as an earnings play, you want to reduce your position sizing to lower than normal as an earnings play, and then see if you can actually make something out of it. So what is the trade over here? The trade over here is very simple. I don't want to spend a lot of money into this. So in this case, because earnings are tomorrow morning, go with straight March 32 strike calls. Straight March 32 strike calls for 80 cents or less. The bid and ask right now is 70 cents to 85 cents. I think you should buy straight March 32 strike calls for 80 cents or less. Keep your position size to what you can afford to lose. All right, and basically look for a breakout through 32. Earnings are tomorrow morning. Look for a breakout to 32 and look for a move higher to 33, maybe even much higher. And so, because I can tell you this, everybody is expecting only 6% growth, order growth, when the first 5 weeks of the year was 14%. The new housing starts are very strong, and the company really got it down last quarter looking for a 6% declining average selling prices. And everybody has moved their estimates down along with it. That's despite 2 quarters of very big beats. So if they come out with if they have to raise their guidance tomorrow, this stock is going to break out. All right, that's essentially the view here. So buy straight March 32 calls for 80 cents or less. All right, and see if we can surprise us to the upside. Anyways, sorry for